So we think valuations are okay in aggregate, and the reason we think that is because even though we're expecting tougher conditions going forward, we think the falls so far this year have largely priced that in. Having said that, we think the falls so far have been relatively indiscriminate, so high quality companies have fallen at a similar rate to companies that require favourable conditions to deliver good results. And so we do think that there has been some disparity open up there. If we look forward to reporting season, we expect the market to focus carefully on the effect of interest rates and inflation on individual companies, as well as ongoing supply chain restrictions and affordability concerns for consumers. So they're the areas we think require further attention for investors. There are some factors there to be concerned about. The first one is a slowing economy and also the effect of higher interest rates and higher inflation. And the key thing to note is that these things will affect different sectors in different ways. So a good example of a sector that we're concerned about is commercial real estate and office buildings. And so where we've seen this rise in interest rates, that's impacting their ability to pay distributions because the interest on their debt is going to be higher. Secondly, work from home has become more of a permanent feature post-COVID than perhaps was anticipated. And we're still seeing today that office occupancy is only a little over 50% of what it was in a pre-COVID world in our CBDs around the country. And so while we have seen valuations come off there a little bit, we think that there are still medium-term concerns for that sector, and so we're avoiding it. A second one I'd like to point out is the gold sector. Now, this seems a little counterintuitive because gold is normally considered a good inflation hedge and a good thing to own in an uncertain environment. But unfortunately for the gold producers, they're experiencing elevated costs and rising inflation in their mine sites. Secondly, the gold sector here in Australia has quite a bit of capital to spend over the next few years on development projects. And we are concerned about those things being on time and on budget in the current environment. And then thirdly, we're also seeing operational performance out of the gold miners generally being a little bit weak. So if we add all those things together, we think this is a sector that remains an avoid for us, despite the fact that gold intuitively would seem like a good investment for this environment. Attractive opportunities for us are emerging in areas where the market's very worried about some short-term concern, but the medium to long-term outlook remains quite robust. So a good example of this is the general insurance sector here domestically. So anyone who lives on the east coast of Australia doesn't need me to tell them it's rained a lot so far this year. What that does is causes an increase in claims. As well as that, we're seeing higher rates of inflation, and so the cost of those claims is going up as well. So the effect of both those things is to significantly impair short-term earnings, and the market has sold those companies off as a result. However, the good news for the insurers is on an annual basis, they get to reprice those insurance contracts. And so we're expecting that stronger pricing and more normalised conditions in the future to deliver quite robust earnings from here, particularly for those companies with strong brands, because in times of higher claims, consumers tend to focus on those more trusted brands. And in NRMA, IAG has the leading consumer brand for home and motor insurance. And so our expectation is that earnings will grow strongly from here despite the weak share price. A second example I'd like to point out is Fisher & Paykel Healthcare. So this is a company that provides respiratory support in hospital environments right around the world. And this company over the last 50 years has grown its earnings by an average of 12% per annum. Now, when COVID hit, we saw hospitals right around the world buy up a lot of their hardware, as well as what they call consumables. These are the tubes and masks that each individual patient needs to help them breathe in distressed circumstances. Now, those hospitals bought as many of those items as they could through the pandemic. And today, as conditions have eased, they've built up a bit of a stockpile of those within the hospitals. And so for Fisher & Paykel, their short-term earnings are impacted while those hospitals use those consumables that they've pre-ordered. However, the medium to long-term outlook looks much better for this company today because of the increase in usage that we've seen right around the world of their equipment. And so we think there's quite an attractive opportunity today. We also like the fact that we're helping support a company that's going to help to save countless lives in the decades to come. Well, it's important to note that we're entering into an environment that looks quite different to the one that we've experienced over the last 10 to 15 years. So we're exiting a period of stable low interest rates and favourable economic conditions. And that environment has been quite supportive for all asset prices, and passive market exposures have done quite well over that period. Our suspicion is a more difficult economic environment will result in much more dispersion between the higher quality companies that can cope well with that environment and those that relied on those favourable conditions to deliver acceptable returns. And so we think it's very important that investors focus on high quality companies. What I mean by that is companies with pricing power, with high operating margins, with strong balance sheets, and importantly, access to structural growth, growth that doesn't rely on a favourable market condition. And it's our view that those companies will outperform the market substantially in the environment going forward. Fortunately for us, these are factors of investing that we're always focused on, and so we remain quite confident about the outlook for our portfolios going forward.